Will the market rally continue? Let's jump in and take a look at what is going on this morning. Doing a little pre-market action here today. The Dow is down just a little bit, S&P up 0.5%, NASDAQ still up 1% off of the back of the Nvidia craze. Nvidia blasted earnings and put even higher future guidance, but they're warning that more chip curbs will end the U.S. chip makers' ability to compete in China. So Nvidia is all the rage right now. And let's see where it's at this point. I think it's up about 6% so far this morning. Let's take a look at Nvidia here real quick. Yeah, up about 7.5% this morning. It jumped as much as 10% yesterday after earnings were released, retracted just a little bit. And we'll take a look at what is going on in the charts with Nvidia. Passing all-time highs, but reaching that double top where it sits right now. So, other companies' earnings a little mixed. A lot of retail misses and a lot of retail retracting guidance because, some are saying theft is creating a problem. Others are saying the consumer is retrading and contracting. And as we know, as people come off the vacation, back to school spending, things like that, they're having to spend money going for back to school stuff, for college, for all the different things. So that's going to take away dollars that could be spent in other areas. And then again, this fall, we're going to have a lot of guidance in terms of what the consumer strength looks like going into Q3, Q4, because of the bills that are going to come due from summer vacations, back to school expenses, things like that. The big event that we have coming up tomorrow on Friday, Jerome Powell speaks at Jackson Hole. And last year, when he spoke at Jackson Hole, that was August, when the markets, sold off down into that October low. So Jay Powell came out, said that inflation was way too high. Of course, inflation was, way high. It was, 2-3 times what it is now, or at least double, close to 9% back then, when he said we had a lot of work to do. There's going to be a lot of pain for businesses and households. And he's been dovish ever since. And the markets largely after it rebounded in the October low, kind of largely ranged until recently with the Nvidia pump and all of the news of inflation subsiding, no recession, things like that. So the consensus is no recession. The consensus is inflation is subsiding. Yet pretty much everybody watching this knows that inflation is still a problem. Food is still expensive. Goods and services are still expensive. Gasoline is still expensive. The rate of inflation, or the rate of prices rising, has subsided a little bit, but prices are still high. So even though, the inflation rate's coming down, which is disinflation, prices are still high, and it's putting a lot of pressure on consumers. People are racking up credit, maybe dipping into the savings, but people still have a lot of equity in their houses. House prices haven't adjusted that much from, very distorted all-time highs. And people still feel that are in the market still feel relatively well off because the markets have rebounded quite a bit from the peak back in 2021. So this is the Dow right here. Rejected on the 786 was that last line of defense. Right now, wrestling with the 702. If it cannot hold the 702, then you might be looking for new lows. But right now, it's a lower high that we have, that all of the indexes have currently put in a lower high based on the recent trends. The NASDAQ has had the most strength, beginning with Apple, then Nvidia took off, and has found support right now on the 702. Rejected the 702, and then ultimately bounced up and found support on it on the back of the earnings and guidance in the tech sector. Right now, the S&P kind of wrestling with that 702. Kind of the same thing that was happening back in August before Jerome Powell spoke last time. So that's going to be key. He's been pretty dovish ever since. So we'll see what his tone looks like in terms of, whether he's going to claim some sort of victory or progress on inflation and indicate that they are moving towards their soft landing. The VIX had a little bit of a pop, retracted. So we could look for a VIX event off of the back of Jerome Powell if he comes out and talks tough. The dollar breaking this little trend here, wrestling with it. We'll see if the dollar can find support on the trend and continue up, or if it's going to reject and just, again, this would be a lower high. You have your high, lower high, lower high, lower high, and lower lows, and continue almost a channel kind of heading down. The 2-year retracting a little bit off of this previous, almost a double top. You had a double top here, kind of a triple top there. generally this triple top pullback won't be too severe in most cases, and could continue on. The 10-year, same thing. And people are piling into treasuries because of recession fears and things like that. So that is interesting because markets are still doing well and pumping a little bit in light of treasuries pumping. So a little bit of an unusual action there. And we see back here in October when the markets were at their lows, yields were at their highest. August, yields were a lot lower, bounced after Jerome Powell's comments, the flight to safety trade into some yield. U.S. oil kind of retracting a little bit back down to 78, coming off of that $84 range. And gold getting a little bit of a bounce here. We'll have to see where that ends up going. Let's take a look at Bitcoin. Bitcoin kind of ranging with this trend right here, playing with this trend line, connecting this level of support going back to January of 2021. Of course, the support of the summer of 2021, right in this area here of 2022, working that trend all the way through, wrestled with it here, lost it, wrestling again, and ultimately finding rejection on that trend line. Trend lines are interesting. The recent uptrend has broken that trend line. So on the 382 retracement level, looking for that 0.5 next at 23,500. Then ultimately the last line of defense at that 702 at 20,000. The probabilities are pretty good that it's going to check that 20,000 level. It may not, but right now in the current situation without an ETF approval, and especially if ETFs get punted into next year, if Grayscale loses their lawsuit, you could definitely see a retracement back to that 702 level of 20K. Then that will be the big line of defense there. If we get some sort of positive guidance on Bitcoin ETFs, spot ETFs, and Grayscale wins their case, you might see a nice little pop and get back up here and start testing that 31.7 previous range level there. If it can break that, then you're back up to the $40,000 range to kind of test that. One of the things we want to look at is the moving averages on Bitcoin right now. As far as the daily moving averages, it has lost all of the daily moving averages, the 50, the 100, the 200. We got the 50 about to cross the 100 here. And the last time that happened, big sell-offs when the 50 crosses the 100. So again, this is a lagging indicator, but still it kind of reflects what's going on right now. That's a big one. And then of course, lost the 200-week moving average, which is the big support for Bitcoin. Historically, that's been the major support for Bitcoin. Lost it here back in June, July, August of 2022. Was not able to recover. Broke above here, found support on June of this year, and now has lost support. So will it bounce back up and be able to maintain that support? Currently running at about 27,395. So that 200-week moving average is a big one to watch for Bitcoin. Ethereum kind of doing the same thing, hanging on. If you put the moving averages on there, broke the trend, found support on the 200-week right now. And as far as the daily goes, still below all daily moving averages. Again, getting ready to have that 50, 100 cross happening. And we've seen when the 50 crosses the 100, that's usually off of a little drop there. So market's kind of hanging in there. Let's take a look at Nvidia real quick. We'll pull that one up. And where is Nvidia? Here we go. So let's take a look at Nvidia. Let's take the moving averages off. Nvidia is finding support on the 50-day right now, but ranging in this area here, putting in that double top, pretty much on the dollar, and retracting a little bit, moving back up. So we'll have to see if Nvidia can maintain this level here, and if they can maintain earnings moving forward. It's going to be difficult for them to maintain earnings because once you mass produce these chips for the GPUs and things, there's only so many of them that are needed. There's been a big frenzy, a lot of front loading, a lot of buying in advance. The question is, how big of a demand will there be moving forward? And then will the other chip makers catch up and start competing and filling in the gaps in the space? You have a gap right here back from May of 23, May of this year. So look for that gap to get filled at some point. Gaps like to be filled, which is down to 315. That'll be a major support area critical for Nvidia, which is just below the previous all-time high. So lots to watch for Nvidia, basically keeping the market pumping right now, a lot of positivity. So interesting time in the market to have yields where they are, to have stocks doing what they're doing, and all of the other things. But keep an eye on Jerome Powell tomorrow. We will have a really good indication of what the Fed is going to potentially do in September, what kind of guidance they're going to provide. And of course, they're going to say data dependent. They still need to get inflation down to that 2% target and things like that. But it'll be interesting to see if he comes out firm against the markets or if he's happy with where the markets are, because it kind of leads into that soft landing narrative that the consensus seems to be. One other thing that we want to take a look at is we want to take a look at Fed funds rate. Here's a historical chart of the Fed funds rate. And typically, rates are, where we're at now in that 5% range historically has been prior to 2003, 2004. So back here in 2000, in the 80s, 90s, rates in the fives were not bad because we've seen spikes up into the 15% range back in the 70s. But since that time frame, you had 1989 rates were in that 9-10% range. I bought my first house in 1990. Interest rates were about 9% on mortgages. The Fed funds has not fallen much below 3% historically over the last 20 years plus, until 2000, when we had the dot-com bust. Rates dropped all the way down to 1%. The real estate market started really heating up there in that time because interest rates drive the market, as does supply and demand. But rates and the availability of credit are the two biggest drivers of real estate values and demand. As we saw in 04, 05, that was the peak of the housing market. Rates started jumping up to that 5% range, 5.25. That's what broke the housing market, 2008, 2009. Rates fell off a cliff and basically stayed flat in the zero range from 2010 basically through effective rate got up to almost 2% in 2018, 2019, but basically from 2009, 10, and that's when QE started and all that, through basically the 2015, 2016 timeframe, 2017 and 18, Powell tried to raise rates. The markets sold off, and rates again after 2020 stayed down below that zero range. So this is the first time that rates have elevated like this since coming off that 2010 to 2015, 16 timeframe. And we all know what the markets did during that time frame. If we just go back and take a look at the S&P during that time frame, let's go on the weekly here, and you can see the results. So here's the bottom in 2010. The markets were just off to the races with low interest rates and QE until Powell tried to correct the rate path. The markets sold off. Rates dropped again, off to the races. Or here's 2018, 2017, 2018 right here, where he tried to raise rates. So basically this whole area here from 2020 up to 2018, when Powell tried to raise rates and markets sold off. Then we went into the pandemic because, he immediately cut rates. Markets were off to the races again. Pandemic was just a temporary stop. But if you take this out of the equation, markets would have just ran all the way up to the peak until raising rates again. This was the effect of the initial interest rates. Rates have doubled since then, Fed funds rate, and the markets are ignoring it and just continuing to rip. So very interesting times in terms of the historical Fed funds rate, what the market's response to it is. But Powell has been very dovish during that whole time. So the consensus now is we've had our correction. Markets are going to go back to all-time highs. We're looking at a soft landing. We're going to avoid recession. So that's the consensus in the market. That's not my opinion. That's the consensus. A lot of banks, a lot of the fund managers, a lot of analysts, a lot of economists are all speaking the narrative. The same thing happened back in 08, 09, the same narrative, same interest rate levels, things like that. So will this time be any different? Will the economy be able to absorb these rates and continue to move forward and generate that soft landing? All we can do is wait and see, but we're going to understand a lot more as the year plays out with the rest of Q3 and Q4. And again, we'll have to see what Jerome Powell says tomorrow and what that guidance looks like. Until then, I will see you on the next video.